What's up, everybody? PoorCryptoSteve here. Today we're going to talk about exponential moving average and the simple moving average. I'm trying a little something different, trying to figure out whether people like seeing the actual screen or whether you like the robotic looking things changing and all that good stuff. So with that said, exponential moving average and simple moving average, they are both types of moving averages used in technical analysis. They both help in smoothing out the price data to create a single flowing line, as you can see down here, making it easier for traders to identify the direction of the trends. However, they're calculated very different. This is what I always want to know. They have different distinct characteristics. It's a lot of the... when you first get in this, you hear someone go 3-day moving average, 3-day simple moving average, 3-day exponential moving average. So when people say 3-day moving average, daily moving average, whatever, basically they're talking about the number that it was calculated with, right? So if it's the daily, we'll refer to things as periods, okay? So right now, we're on the daily chart. As you can see right here, it's the 1-day chart, and we have a couple moving averages. I believe these are both 200s. We can look right here and we will see if we go into settings for these. The red one is going to be our exponential and the white one is our simple. Now, because they're 200, what that means is they're 200 periods, right? So as we're on this chart, it's the daily. So it's 200 candlesticks. So if we started from here and we went, if you notice this down here at the bottom, it will count the number of bars. That's 500. So roughly, right. Oh, so close. All right. So there, we would be looking at from this period to this period. All of these are counted. Let's see if we can move this without, we can't move without it going away. Okay, so let's just guesstimate on this, right? We'll say from here to here, this actual calculation is based off all the closings of each candle all the way back to here, right? Okay, so that's how it's getting. Now, a lot of people only use the 200 moving average over very long time periods to see whether we are in a full-on bear or bull market, right? So the simple moving average is calculated by taking the arithmetic means of giving a set of values in the context of stocks prices for a 10-day simple moving average. You would sum it up. Probably, let's see, I don't know where I'm at. We'll say there or there or there. We're going to put up a formula on the screen, right? Basically, the formula is for the simple. It's just the sum of all of those candles divided by the number of days. That's it, right? So let's say we have a, let's go. All right, first, see, this is why I do other weird videos, because right here we're going to go with 10 different moving averages, okay? We're going to click on the 10 different moving averages. We're going to come to settings and we are going to make a 9. All right. And we're going to do a simple moving average of 9. All right. And we got to give it a color. That's what happened. We didn't give it a color. We'll make it, what did I say? White earlier? All right. Okay. Why will you not give us... got to check it, right? Okay. Now, as you can see, these follow way closer, right? So if we're talking about 9-day moving average, we could take any 9 candles. We could start here, 1, 2, 3, 4, 5, 6, 7, 8, 9. And that means this right here, okay? Any of these candles. This number is calculated off the previous 9 candles, and this number is calculated off the previous 9 candles. So why are they so different, right? Now, even if we went to the hourly, right? We go to an hourly. We can blow this bad boy up. And this is not the daily simple, right? This is the 9 periods, right? So these two lines right here are both created off the previous 9 candles. Now, how does that math work, right? So for the simple moving average, it's very simple. Boom, 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 somewhere above my head, beside me, that way. I don't know which way the camera faces. It's basically these 9 candle closes, which crypto's open 24, but each candle closes every hour because these are the hourly, and the daily 8 p.m. Eastern Standard Time, right? So it will take the closing number of that. It will take the average closing candle, all 4, the last 9 periods, right? We're on the 9. So it's going to take all 9 of these candles right here. It's going to add the closing price up, and it's going to put it there over that number of days, and then divided by 9, because there's 9 periods, right? So if this was 100, this was 100, this would say every one of them closed at 100. You can pretty much say this line's going to be sitting at 100. This would be straight across, right? But it's going to take each one and it's going to average them out. It's going to give you that. Now, what about the exponential moving average? That, boom, 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 somewhere around me, there's going to be a crazy formula, which it's going to be close, EMA equals close minus the previous EMA times 2 over n plus 1 plus previous EMA. So what does all that mean? It sounds crazy, yes, but basically the further, if this is the candle, V, okay. So what we're going to do here is we're going to remove that. We're going to remove that. All right. So if we take this candle right here and we say the previous 9 candles count, right? 1, 2, 3, 4, 5, 6, 7, 8, 9. So we have another alt. Why do I get vertical and horizontal so mixed up, right? Okay. So if we're doing between this candle and this candle, what it does is this candle is weighted heavier than this candle, which is weighted heavier than this candle, which is weighted heavier than this candle, and so on and so on. Whereas your simple moving average treats all 9 of these candles the same. It's just an average of these 9. The exponential, the closer the candle is, the newer the information, the more weighted that information is treated. So therefore, it tends to stick with closer to what's going on. If there's big swings, it's going to move along with that swing. Whereas the simple, even if there's a big swing, it's going to continue to smooth the same way. Now, why are these used different, and what's the deal with them? So over the longer time frames, you'll see a way larger difference, right? If we go to the daily, we've already zoomed out here on the daily. We've lost everything. There we go. On the daily, you're looking at these two right here. We're going to go with red and white. Of course, you got your simple and you got your exponential. You can see they flow kind of very close together, right? Now, if we get over a very long period of time, and we go all the way back to the bull run, and now you can see these pretty much stick within here, right? Because so what information is that giving us? It's not giving us a whole lot on the daily unless you just really zoom in and you're looking at small moves. But if we want to come over here and now we want to add another exponential moving average, and we want to make this one 200. And we want to add a simple moving average, and we want to make it 200. Now, exponential are going to be the red one, so we'll make an orange one, right? And since the simple was the white one, we're going to make it somewhat of a white. Let's go with something that we want to make it kind of different. We'll use yellow, maybe, okay? So orange is going to be exponential and yellow, right? Now we have to turn them on. And we have to hit OK. So let's say yellow and white are simple, right? Maybe I should write that down, right? Yellow and white are simple. And red and orange are exponential. And we know the 9 days are going to be closer than the 200, right? So let's hit OK. Now let's really see what this is saying, okay? What this is saying, the smoothing effect is where you're going to see here. As the price went up, these take 200 periods to actually takes into account 200 periods. Now, if we look at the orange, which it's the exponential, it's moving like this. But when there's a big change, it takes longer for it to adapt to the change, right? It adapts to the change quicker because it uses the most recent data, takes the most recent data and it's weighted heavier. Whereas the yellow, it takes all data, treats all data the same. So see how it doesn't just slam up and down as much as the exponential slams up and down with the price more, right? So the yellow, simple, it's slowly moving. The exponential is more responsive to what's actually going on, right? Okay. All right, let's talk lag. The SMA has a greater lag since it considers all data points within the time frame equally, so it's going to lag more. The EMA reduces the lag by applying more weight to the recent prices. As a result, the EMA can often be closer to the current price than the SMA. As we zoom in, you can see that, right? There you go. The applications, the SMA can be used to identify and support and resistance levels as it crosses with the price chart. It can sometimes be used to identify potential buy and sell signals. The EMA, due to its sensitivity, it might be better suited to identify short-term price reduction, potential trading opportunities based on the price crossover. Sensitivity to price gaps. The SMA, since it takes all price equally, it's less sensitive to sudden price shocks or gaps. So things change real quick and then go right back up. It doesn't quite go as crazy, quite as insane in the movement, especially when you start looking at it here. They both went down and then back up, but it affects the simple moving average a lot less. So if you're just looking at kind of long-term stuff, simple seems to be better. The EMA reacts more quickly to sudden price movements or gaps given its sensitivity to recent data, right? So the more recent the data, it's going to have more of an effect on it. So in conclusion, both EMA and simple EMAs are essential tools in technical analysis. The choice between them often comes down to individual trading strategies, what you're trying to do. Some traders prefer the responsiveness of the EMA, while others value the smoother and more stable indication given by the SMA. Often analysis will be use them in tandem with more comprehensive picture of the market's movements. So for me, more of a swing trader, I like the simple moving average. But more day traders might want to use the exponential moving average. I find either way, when I'm looking at things, the long like the 200, they're about the same to me. I know I can tell you either way, whether you're looking at exponential moving average or simple moving average, when we get price action above the 200, they tend to both do about the same. When you're looking at long over the long haul, we feel bullish when we get above the 200, and we feel bearish when we get below. These are things that help you see the bear and bull coming. And I honestly only use the 200. So other people, this may be a bigger deal for, but I am not a moving averages person per se. So tell me what you think. It's not something I use a lot, but I've always wondered what the difference was between simple moving average and exponential moving average. And really, it's just the weight. Exponential uses the most recent data is weighted heavier than the simple. Simple uses everything across like it is simple. I think of it as simple interest, right? Okay. So, hey, let me know what you think about that. Do you use SMAs, EMAs? Like I said, I like to use the 200. I like to go, oh my God, we're below the 200. We're in the bear market. And then I go, oh my God, we're above the 200. Is the bull run starting? I don't know. Let's see. We'll all find out together, right? Tell me what you think. Do you use EMAs and SMAs? Is it part of your trading? Was this helpful? Did this help explain what they're used for and how their calculations are done? Let me know. And hey, thanks for watching.